Bellis, representing Police Commissioner Kelly, also present today.
Doug Maynard, representing the Police Department.
Barry Dennis, SAS.
Pat Hendry, PVA.
Chris McGrath, DVA.
Steve Verbilia, LBA, and proxy for the SBA.
Michael Palladino, DPA, proxy for the county.
Barry Miller, Comptroller's Office.
Martin Gans, Controller's Office.
Sina Ingrani, Controller's Office.
Thad McTee, Controller's Office.
Larry Schloss, Controller's Office.
Justin Holt, Department of Finance.
Janice Emery, Mayor's Office.
Bob Senskestead, Pension Fund.
Ray Cirola, Mayor's Office of Pensions and Investments.
John Bright, Controller's Office.
Rhonda Kevin Pension Fund.
Okay, we'll turn it over to Larry.
Thank you. Everybody have their monthly review? Yes?
Yes.
Absolutely. Yes. All right, I'll go quick because it's good news, so that's always quick. If it's the bad news, it takes more explaining. Just in general, this is December. We're now, it gets midway through February. And since probably the beginning of December, the markets have been calm and up. So all good. The only thing that's backed up a little is the risk-less investments. So let's call it the 10-year Treasury, which has sort of gone from 1.7 to 2%. And that's people, again, calm means less safety, so they're bailing out of safe investments. Again, the calm is, there's undertones of uncalm. Uncalm being what's going on in Congress relative to the grand deal, if you will, or some semblance of trying to get a hold of expenditures, as well as uncalm of, in Europe, no one's paid back a penny of debt, but the ECB has flooded the market with cash, so things are pretty good. Rates are down, and the sovereigns can finance themselves. If you go quickly to page 32, you can see the last 12 months of the police pension fund has basically been pretty much up. It's the highest level ever at $27.2 billion. January is also up, so we're probably pushing $28 billion. If you look at page 33, you can see how it looks from a 10-year perspective. We've added this line just because people were asking. So for 10 years, the pension fund's up about 8.1%, which is pretty damn good, actually, particularly given the dip that happened in 08 and 09. If you roll forward to page, all right. I lost my page. Here it is. Page 39. And you just run your eyes down the far column on the left, which is the month of December, the markets. The first clump of numbers is the U.S. equities markets. And they're up sort of, let's call it 2%. The next clump are the international markets. They're up about 4%. You can see the next clump, a little bit of negatives there, particularly the treasuries, is the fixed income market. And things are good in December. Better still, if you go to the next page, 40, you can see let's call it the January effect. The U.S. equities markets were up 5 to 6%. International markets were also about 5. Again, you can see the continued backup in the fixed income markets, probably down 1%. Let's go back then to page 35. Look at how we're set up. We're set up pretty much spot on our asset allocation numbers in the equities. We continue to be at the high end in fixed income and at the low end in core plus 5. That combination of things, if you get to page 41, and again you look at the far left, we made about 1.5 points in the month of December, which brings over to and everything was positive except for a little bit of backing up again in core plus 5 and tips. If you look then over at the fiscal year to date, which is the middle column, we're up about 6.7%. I guess we're up about 2% in January. And it looks like February will be also up, so we might be pushing 9 to 10% up through February. February hasn't finished yet, but all good so far. Expect more volatility as we get toward the end of March, particularly coming out of Congress. So everything's good. The managers basically performed in line with the indices. And the markets look like the wind is slowly at their back. So with that, again, halfway through the year, we're up 6.7%. Good news in January coming, good news in February coming. So all pretty good. Any questions on the results? Okay. Today we have a couple of presentations. One is from John Bright on risk. It's going to be followed up by Barry commenting as well on risk. John? I want you to sit here.
I did that last time.
I don't like to hear it. You have a lot of fans in the audience.
I've never been able to follow the numbering in these things, which is eccentric, but it's about 4/5 of the way through the book.
It's page 67.
Oh, I see. It's actually smaller than I can see. The numbers. Yeah, so I last saw you all a year ago, so Barry's asked me to remind you of my background. I'm the risk advisor to BAM, and started out my life as a physicist, and then went to Wall Street, as many physicists have done, and ran various departments at several different firms, most notably risk management for a number of years, and also product control, also reported through me, which was responsible for valuation of all the weird stuff we had on our books. So that's my background. Last year, I gave you all a presentation that had lots of statistics in it and numbers. This year, well, first of all, the statistical measures essentially haven't changed since the year before, so it would be boring. But also, I'd like to get away from that because sometimes we can get so lost in the weeds of the statistical analysis that we can lose sight of what's really going on in the portfolio. So I'd like to take a step back and do what I think is the risk manager's primary job, which is to identify the biggest threat to the portfolio and what I think we can do to mitigate that threat. So we'll start off just by reminding everyone what our risk is, because sometimes it's easy to confuse it with various statistical measures of volatility. But the risk essentially is that we don't earn enough to pay benefits. And that can come from volatility. It can come from losing a whole lot of money in a hurry, but equally it can come from simply not earning enough on the investments. Now, in normal times, and by normal times I mean times when the Federal Reserve hasn't manipulated interest rates to the point where they're essentially nil, we can invest in treasuries, in corporate bonds, in junk bonds, and while we may not quite make it to our actuarial rate, we come close. We're going to earn 5–6% on corporate bonds in normal times. And so then to actually get to the 7%, maybe we add some equity in, but we have the luxury of keeping a large fixed income portfolio because it doesn't cost us that much. And we can then worry about day-to-day volatility, and if we have too much in equities, we may lose a lot of money in a hurry. So we can then pull in all the paraphernalia of traditional risk management, all the statistics, and look at Sharpe ratios, and look at efficient frontiers and the correlations amongst various asset classes and so forth. And in addition, we can be very grateful for the fixed income portfolio because not only is it not as volatile as equities, but typically what happens in a flight to quality when equity markets crash, the fixed income portfolio rallies, as happened with us in 2008. And we get some joy out of that, which makes up for the losses on equities. But what I'd like to argue on the next page is these are not normal times. The Fed has leaned on the entire yield curve and made rates historically low. The Fed is punishing savers and is punishing pension funds by making it very, very difficult to earn our bogey, to earn the returns we need. And low rates are a threat to our ability to match our liabilities. We have a long stream of liabilities out there for the foreseeable future. And with low rates, it's very difficult to risklessly, or even with moderate risk, earn enough money to fund those liabilities. So there's a mismatch between our assets and our liabilities. And the fixed income portfolio we have then makes it much harder for us to fund these liabilities because the rates are so very, very low because of what the Fed does. So in this environment, I think it behooves us not to look at the short-term volatility and the risk that it poses, but the long-term risk of what happens if the Fed keeps rates low for the foreseeable future. How do we earn 7%? And essentially the problem is on our fixed portfolio, our fixed income portfolio, we're lending to corporates, we're lending to the government, we're lending to various people at 2%. And our bogey is 7%. A bank that borrows money at 7 and lends at 2 will not be in business very long. And now, some numbers just to belabor a bit the effect of interest rates. Just give an example. Suppose tomorrow the Fed jacked up rates 500 basis points. Well, initially it's a disaster. We take a mark-to-market loss on our fixed income portfolio. But in the long run, that would be one of the best things that could happen to us. Because now we're suddenly going to start accruing at a much higher rate. And in the long run, the higher accruals win out over the initial mark-to-market hit. And there's a chart here just showing we have roughly $9 billion in fixed income. If rates went up 500 basis points, well, we lose $2.3 billion. But then now we're going to accrue at a much higher rate. And by the 6th year, we've broken even, and after that it's gravy. We're actually making more money in a high-rate environment. The converse of that is also true. The rally that we all enjoyed in fixed income, which brought us capital gains, has essentially gone away in low accruals over time. So, however delightful it is for the short-term volatility to have a rally in interest rates, over the long run, it costs us far more than we get in. So, what does all this mean? Bob North's actuarial rate is 7% after expenses, so call it 7 3/8, really. We have a third of our portfolio earning about 2%. That means the other 2/3 have to earn 10%. That's a very heavy lifting that we're demanding of equities, alternatives, and other parts of the fund. And it's an optimistic assumption to assume that that remainder of the portfolio can do that very well to make up for the drag caused by the fixed income portfolio. So, if the Fed keeps rates low for the foreseeable future, and they've shown every indication of doing that, how do we mitigate the risk of inexorably falling behind? Well, the first thing is, in a low-rate environment, you don't want to be a lender. You want to be a borrower. How can we be a borrower rather than a lender? We should accelerate the allocation we have to fix the reduction in allocation. We've been paring down Core Plus 5, but we should do much more of it. And stop lending money to people at 2%. Makes no sense when our bogey's 7%. Expand the rebalancing ranges so we have the flexibility to do that. And continue, but at an accelerated pace, our program of increasing our exposure to the bottom of the capital structure. Private equity, they borrow money and lever up. Real estate, not the senior tranches, but the mezzanine and the equity tranches of real estate. Use hedge funds and futures funds to leverage the portfolio and go more into high yield and more into foreign bonds. Now, these add to our risk in the traditional sense of volatility. We will have to cope with a more volatile portfolio, but they lessen the risk of inexorably falling short of our bogey if we continue to be in a low-rate environment. And if the Fed does jack up rates, we'll be okay. We can then buy fixed income. But it makes no sense to me to sit in a 2% environment right now. So just to show, if on equity and alternatives we actually manage to earn over the long run 10%, then we're okay. We have our 2/3 in alternatives and equity, 1/3 in fixed income, and we won't require additional contributions from the city because we will meet Bob North's bogey, and Navarre is about $1.4 billion. If we only earn 7% on equities and alternatives, which is still a quite respectable long-term yield, then in order to not need additional contributions, we'd have to have the whole portfolio in equities and alternatives and eliminate the fixed income part. And our VAR would go up proportionally because we're now in more volatile stuff. And if we're only going to earn 5%, we have to lever the portfolio up. We actually have to borrow money and invest it. Now, this may seem like an odd thing for a risk manager to be saying because it does increase this sort of leverage. Getting rid of the fixed income does increase the day-to-day volatility, does increase the embarrassment for all of us if we lose a whole lot of money in a hurry. But the alternative, to my mind, of continuing on the path we're on is losing a whole lot of money slowly. Because you cannot borrow at 7%, which is effectively what we do through the actuarial rate. We borrow from the future and lend it out at 2%. Doesn't make sense. So I would encourage all of you to think about using leverage, either explicit or the sort of implicit leverage you get from expanding hedge funds, expanding private equity, and putting more money at the bottom of the capital structure. There are two practical constraints. One is the basket clause. Now, Thad's going to be making a presentation on the basket clause, but it is a severe impediment to doing this sort of thing. It's an anachronism, and throughout my career, I would find, particularly in dealing with municipal governments and pension funds around the world, that legislatures are not at all shy about imposing contradictory mandates on people. So the legislature would say you have to earn 7%, and also that you have to keep a certain amount in stuff that only earns 2%. It makes no sense, but they're the legislature. They don't have to make sense. Inevitably, it has bad consequences. I'll give you one example from early in my career. The Japanese pension funds, the Ministry of Finance there, required, I think, it was either a 4 or 5% return for the benefits. At the same time, they required that they buy only AAA yen-denominated fixed income assets, the yield on which was roughly 1%. It's impossible. Didn't faze them, but it's impossible. So what did the pensions funds do? They went to derivative desks on Wall Street, and bought what I used to like to call wolf in sheep's clothing bonds. So something that the issuer was AAA, but what you really had in the bond was the returns of an Indonesian cement factory in Indonesian rupiah or something like that. And everyone was happy. They could comply with the legislature, and they could also get the returns that were demanded. The problem was they wound up in worse shape than if they had simply relaxed their equivalent of the basket clause, because they paid bid offer fees to us on Wall Street. They wound up with very concentrated risk. It's the anachronistic, arbitrary rules almost inevitably increase your risk. So I would encourage everyone to look hard at relaxing the basket clause or getting it up to a more reasonable level so that we can stop lending at very low rates. The other practical constraint is you all are going to have to accept more volatility if we go down this path. Look, I don't like volatility. As risk manager, my ideal world would be that Bob North set the rate at 3%, the actuarial rate, and then we could fund it risklessly. That's never going to happen. There isn't enough money around for anyone to do that. So if we have a rate of 7%, I think we have to do what we can to try to earn it and not handicap ourselves by having a large part of the portfolio which has low volatility, but on the other hand simply puts too much of the demand on the rest of the portfolio. And now any questions?
Well, let me just circle back a little bit to, so this is the view from Riskland. The view from what we've done in the past is totally consistent with what he's saying. So if you go back to the asset allocation that we redid in the summer of 11, we said more private equity, more real estate, more opportunistic fixed income, and more hedge funds. So we did everything that you suggested. And if I look on page 10, we're kind of in the 2/3, 1/3 buckets. Of course, the problem's going to be earning 10% on the equities, which is a stretch, so we might be a little short, but we're kind of moving toward what you're talking about.
Yes, yes.
Well, on the other hand, our move toward it was to reduce the volatility.
Yeah.
Because we weren't going far enough, right? So we've got this alchemist approach to, if you do it, I don't know, halfway, it's less volatility. If you go the other half, you increase the volatility.
Yeah.
And that's the next asset allocation, which will be, I don't know, 18 months away or something like that, as we get closer to fulfilling what we said we're going to do, which is the hedge funds, the optimistic fixed income, and the real estate and the private equity. Barry, you have some thoughts on this, right?
Sure. Well, first of all, I agree with everything that John is saying to an extent. And let me get out the extents. The extents is that it's somewhat at loggerheads with what we said in 2011, which was, for now, until things heal, we have to be aggressive. But at some point, we have to de-risk the portfolio. And what John is suggesting is the opposite of de-risking. It's upping the risk. So at some point, we have to get a balance. Yes.
In terms of volatility.
Correct. Correct.
I would regard it as lowering the risk that we just don't ever make enough money.
I understand that. But it's just, there are multiple definitions of risk,
Yes.
and I'm talking about standard deviation
Yes,
risk
yes.
in that term. I really like the chart that John has that shows, what happens if interest rates go up 500 basis points tomorrow and we come back out whole in 6 years. That's sort of a best case scenario. If you looked at that chart again, and instead of rates going up 500 basis points tomorrow, they go up 500, they stay where they are for 10 years and then go up 500 basis points. That's the worst case scenario.
Yes.
That's terrible, because you only collect 2% for the next 10 years, and then you take a 25% haircut in year 10. So, you say, well, when our interest rates are going to go up? And, nobody knows, but what the market is telling us, if you look at forward curves, is it's going to be about 7 years. So I'm looking at expected money market returns, and they stay below inflation out the curve for 7 years. So the market is saying those rates aren't going to go up for 6 or 7 years. That's how long we're going to stay in this crummy condition, which is scary. I would say the other extent that I would argue with John about is if rates do stay low and inflation stays low, maybe we don't have to earn 7%. And it sort of goes like this. We have to focus on the real rate of return. So the actuary is assuming 7% return and let's say 3% wage growth, wage inflation. Now that doesn't include merit increases or seniority increases, so don't get upset over here on the side of the table. So 7 minus 3 is 4% real. Now, if our estimate on inflation over 10 years is 2.5%, maybe 2.4, put 4 on top of that, and you're at 6.4 or 6.5, add another 30 for expenses, and you're at 6.7 or 6.8. Maybe you don't have to earn quite 7, which would temper some of what John is saying, and I believe that's a smarter way to look at it. So, where I do agree with John is this bonds don't seem to be a good deal. And about a year ago, I told you to get to the bottom of your tolerances on anything that was sovereign, so treasuries or tips. And you did. And it's actually worked out pretty darn well. So what would be the best approach to take in John's concerns and my concerns? And it would be an investment approach that has become known as risk parity. And I'd be happy to run a educational session on risk parity for you. But what it does is, John talked about explicit leverage. You borrow at the fund level. Say you borrow 40% of your assets and invest the proceeds from that leverage into bonds. So instead of getting 2%, you get 4%. Then you're okay. Problem? We can't do it. The basket precludes that. So that's another constraint of the basket beyond what we're looking at today, which is looking only at unlevered portfolios. What's the next best thing? And I would agree that we should probably look at those tolerances around fixed income and especially the sovereign stuff, because that's where you're really getting the squeeze. And to me, relaxing those slightly is a suitable approach.
Yeah, and I would just add, I mean, my theme essentially is we can't have our cake and eat it. Yeah. We would all love low volatility, and we also want 7% returns, and it ain't going to happen. And the other thing is, we've moved in the right direction, but I'm still new to this from the private sector, so I'm used to things happening at a faster pace with more urgency. And I feel a real urgency to get this portfolio in a position where it has a fighting chance of earning enough money.
Well, may I?
Sure.
I really like the idea of us looking at a risk parity approach. I think that for us to concentrate our risk in any one particular area seems to presume that we know what's going to happen in the future, and we simply don't. We don't know what's going to happen. And so what I think we might want to do over the next couple of months is take a look and learn more about a risk parity approach that Barry is suggesting. And because we can't create return in the portfolio. We can only take what the market gives us in terms of return. But what we can do is better understand what our risks are in the portfolio and better manage them. So I think that was a very good suggestion.
Look, if the Fed continues to keep short-term, the Fed has essentially been recapitalizing the banks by letting them lend long and borrow short and keeping the short-term rate nil. If they're going to keep doing that, acting like a bank and letting them recapitalize us is not a bad idea. And that's essentially what risk parity would be. It would be borrowing short-term money and investing it long and boosting the yield that way. I would be delighted to see us do that. I think that's a harder struggle because that's explicit leverage, not implicit, and really requires the cooperation, I would think, of at least the legislature to allow that to happen.
Isn't it ironic, we're sitting here on the after effects of a massive debt bubble, and you guys are saying you want to add debt? Am I missing a point? But I get what you said.
Yeah, yield curve, not explicit debt, but yield curve.
Okay. Yeah.
Yeah. No, I find being at the bottom of the capital structure, so the implicit leverage less scary than that. Yes, I agree.
Okay, any other comments, questions on risk?
Thank you.
Perfect. So that's a good setup to you, Tad, because we do have this rigidity called the basket clause.
So if you turn to page 78 in the book. As Larry indicated, after Larry's presentation, after John's presentations, Larry's comments, and Barry's presentation, I don't know if there's a whole lot more that I could say. The request we have of the board, and we've had a number of conversations on this subject, is to ask the board's support and be on record, as we have with the other boards around the city, to approach the legislature to increase the basket clause to 35%. The context I would give you for this presentation is that going back to when we did our last asset allocation back in the spring-summer of 2011, we ran a number of scenarios, and as the board knew at that time, as we sort of ramped up into areas such as private equity, hedge funds, opportunistic fixed income, we would essentially be utilizing the room we had with the 25% basket. So we had a number of conversations as the best way to achieve asking the legislature to increase the basket to 35%. And there were some issues in terms of governance, whether or not it should be part of a governance conversation. And as the legislature's session started in January, this is why we've come to you today, again, to sort of formalize that we think the best approach is to ask the legislature for an increase in the basket, and that given the past history of the increases, the most appropriate ask at this point is 35%. That seems to be, in our mind, the most practical. So if I could have you turn to page 79, and I'll run through this quickly since we did some of this last month. Essentially what the basket really is for all of the 8 pension systems in the state of New York, there's this construct called the basket. The legislature defines in the state's retirement Social Security law what is a legalist investment, and those items that are not considered legalist investments fit into the basket. And I think on the next page, page 3 of the presentation, it's interesting to me that that list on the right-hand side is quite large. So as opposed to some of our peers around the country that may have other constraints, we have a lot of competition for that 25% basket. We have, as we mentioned, private equity. We have non-U.S., which I think is a huge one, non-U.S. in excess of 10%. And I could go through the whole list, but I think we all get the idea. So when we have this constraint, it's a very difficult constraint to deal with because it's competition for what is the most efficient way to run a portfolio. And I think what you also have to realize too is we have the denominator effect. In periods where there's been market turbulence and the denominator has gone down, we've really had to pay close attention to our pacing. And even in cases, for instance, if you were to get a market downturn and we'd have a hit to the denominator, Barry or Yvonne, for example, the board is, through their guidance, has made commitments to funds. We're going to call that capital down, so we're legally committed to do that. The next page is as of the end of last quarter, and it shows you sort of versus fund policy and on an actual invested basis what our headroom is. The next page is an example of some of our peers and who has some sort of restrictions that John and Larry talked about. I think that if you go to the following page, page 6, what's interesting to me is we have a couple of examples of your peers, public funds, that have constraints. And to the extent they have constraints, our research indicates that those constraints are much narrower. So again, it goes back to that page where you list all our basket clause and basket clause type of investment opportunities. They're quite extensive, and we're sort of in some ways hamstrung. So as we mentioned earlier, and John and Larry had mentioned earlier, our recommended action is to pursue an increase in the basket, number one. And number two, we think that the increase, the most practical increase at this time is 35%. That's based on our review of past history as well as conversations with folks as to what is the most practical way to achieve the desired outcome so that we can continue to invest the fund most efficiently. If I go to the next page, I'll turn it over to Barry. At the last meeting, there was some conversation as to what would be the right number, why 35, why not 40, and Barry ran some scenarios which I think tell you that 35 seems to be the right number given the context of where we are with our asset allocation, but I'll turn it over to Barry for that.
Okay, a couple of things relative to, or one thing relative to what I said last time was, last time for what goes into the basket, we were assuming that the non-core real estate went into the basket, which was sort of the old law. It was changed, and now it's real estate over 10% goes into the basket. So there's a different definition of basket in our work, and I apologize, we weren't aware of that change. But that really doesn't affect the world. So when we did asset allocation in 2011, as Larry said, we increased things like real estate, private equity, and hedge funds, and that's worked out pretty darn well. The other thing that happened at that time was with the increases to those things, we cut our non-US equity exposure way back. So today it's less than 1/3 of the public equity exposure. And let me tell you, that's worked like a charm. But you don't drive the bus looking at the rearview mirror. Looking forward from today, our expectation for non-US equity is actually higher than the US. And I can go into the reasons why. They're pretty simple. But the basket at this point is constraining us from actually doing that. So if you look at how the world market cap is distributed, today it's 53% non-US and 47% US. So relative to the market, we are way underweight non-US equities. And I think in the future, that's going to pinch a lot. So I really think it's important to raise the basket level above 25. Now, so if you look at my memo, going forward, if we go to 35, and I call it 35 to 40, we actually get up to about 37, and we can make tweaks to do that. You see that the real beneficiaries of this increase are the non-US equity portfolio, where we're actually getting bigger weights in non-US than US, and the hedge funds, which go from, what are they today, 4, 5 to 10. They basically double. But it does improve the efficiencies. And the same as last time, as we go for higher and higher return, the basket becomes more and more pinching. So then we actually tried to get the basket up to 50%, but we just, in an optimal world, we can't get there. We'd have to raise the expected return above 8% to get 50% in the basket, because then you'd be really loading up on private equity, which is the only asset class that has an expected return above 8. So you'd have to take a lot of that. And I'd also say, if you look at that panel where we get to 45, there's a line there just above the basket allocation that says illiquid. And the illiquid portfolio includes real estate, private equity, and hedge funds. So that's getting up to 40%, which we sort of think is getting in the red zone, danger zone. And why is it dangerous? Well, if you got 40% there and the other 60% collapses by half, now you're 60% illiquid, which really puts a crimp on your ability to continue to pay benefits. So I agree with Thad that going much beyond 35 is not going to help you. Let me caveat by saying if you want to look at risk parity, that might change the ballgame. And you'd want to pursue more of a prudent expert, prudent investor type statute than to continue with a basket limitation. Because I believe all that leverage would go into the basket. So, for now, 35 is good. If we go through the educational process on risk parity and it appeals to you, we might be going back to Albany.
So I think for now, what we'd like to do is ask the board to be on record as pursuing an increase to the basket to 35%, so that we can pursue that as a legislative remedy. So if the board's okay with that?
Need a motion.
Well,
Janice, do you have a question?
I just have a question. So Thad, you had generously offered to sit down with us and walk us through a lot of the detail. And I know we haven't calendared that yet, so can we?
We're in the process of
Okay.
getting people together. Your staff, probably too much inside baseball, your staff gave me a list of folks who'd like to come to the meeting, so we're just making sure that we have the right people to answer
Great.
all your questions.
Okay, thanks. Yes, so that meeting hasn't happened yet.
But I would point out, you did ask some questions, which we also sent responses to, so, we're happy to ask the board to go to 35%, and if something should change through the meeting, or anything obviously happens with the legislature, our intent is obviously to partner with the board and make you aware of all the changes, but I think the initial step would be to ask for a motion to go to 35 today.
Janice, do you have
Second.
that information? All right, so maybe we should do a roll call vote. Janice is saying that she's not prepared at this time to vote for it.
Right.
Do you wanna
Did
do-
we get a second?
Yeah.
Okay. So the mayor's office
So
abstains.
why don't you call the roll?
All right, roll call vote.
Mayor's office abstains.
Finance,
Department of Finance abstains.
okay. Police commissioner,
Abstain?
controller,
Four.
PBA,
4.
SBA,
Four.
LBA,
Four.
DEA, and CEA. All right, motion carries.
Thank you.
Great. Thank you very much. We'll be back here as that evolves. That ends the public session for the public agenda. So I guess we need a motion for the.
Motion to exit public session and enter executive session.
Second?
Second, all right. All right, so moved. No objections, okay, boys?